Well, before I get started, I'd like to get to know my audience just a little. So I want to get an idea of your field of expertise, interest, whatever. So whether you're a student or you're actually in practice of some kind, I want to know, I'm going to give you 4, 5 maybe categories. So first, how many of you are in finance? Again, either studying or in business. Oh, cool. How about philanthropy? Okay, couple. How about entrepreneurship, business? Awesome. And all other industries. Anybody? Generally. Okay, well, that's really helpful. So as Bhavna said, I spent almost 30 years on Wall Street, and I loved finance. Now, I didn't always love finance. I grew up in Ohio, and growing up in the 70s, when you were a woman and you wanted to go to college for a career, you kind of had 2 choices. You could either be a school teacher or a nurse. And I thought, I don't like hospitals, I don't like doctors, I probably should stay away from nursing. And so I decided, okay, I'm gonna become a school teacher. And I think I like kids, so I'm gonna become an elementary school teacher. And after my first semester of student teaching, I came home in tears and I said to my mom, this is not gonna work. And being a good mom, she said, honey, you have to stick it out. 1 semester, right? You'll probably find that you really like it. And on my last day of student teaching that semester, I said, Mom, this is definitely not gonna work. I need something else to do. And I was really lucky because my best friend's mom, she worked at a bank in Ohio, and they had a trust company and an investment company. And so she said to me, have you ever considered a career in finance? And I was like, nope, I don't even really know what that means. But I like math, so this might work. And my very first job was typing stock certificates and balancing shareholder records. So that was back in the day when you had typewriters and you actually had physical stock certificates. And if somebody wanted, you wanted to sell your shares to him, you would basically mail them into me. I would stamp them physically, canceled, put a new share certificate in my typewriter and issue new ones to you, and then write it down in my ledger. And the really cool thing about that was I really got to know finance from the bottom up, because then I moved to the bond department and learned how that all worked. So there was an advantage to being old, because now everything is automated and I don't think anybody even thinks about how it gets created or how it works. But I found that I absolutely loved everything about it. And so I just kept getting promoted. And then ultimately I got recruited to California in 1984 by Security Pacific Bank, that's no longer here. They got bought by Bank of America. And by 1991, I was the CEO of Bank of America Capital Management. We were about a $35 billion global asset manager. And again, I just really loved everything about what I was doing. And then around that time, there were lots of other acquisitions and banks were growing. I ended up getting recruited by Deutsche Bank to be the CEO of their US North America private wealth management division. And they had just completed 4 different acquisitions that had private wealth management businesses as part of them. But that's not why they did the acquisition, so nobody really cared. And they never integrated it. And so by the time they got around to saying, oh, wow, this division is losing a lot of money, they figured we better really go out and hire someone. So they recruited me. The job was in New York. I lived in LA. And I'd always traveled, though, as part of my job anywhere, so it didn't matter. And I thought, okay, that's fine. I can commute to New York. But when I went and met everyone, I was like, oh, gosh, not only is this a big bank, it's a German bank. And, I'm just thinking everything is going to be very bureaucratic, and it was. But when I saw the numbers and I saw what needed to be done, I got so excited because they were losing $130 million a year. And they had all kinds of duplication all over the place. And so the reason I got excited was because I thought, I can't make this worse. It can only get better from here. So I can be the hero. And I ended up, and it really was actually very fun. It was like a puzzle. And one of the things that I love doing is solving problems. And so it was kind of the perfect job for me. And in 3.5 years, I orchestrated with my management team and a consultant the most successful turnaround ever of a division at Deutsche Bank. And it was fun. It was really fun. I was commuting to New York Monday through Friday. I also was on Deutsche Bank's executive committee, so I had to be in London or Frankfurt like every 6 weeks. But still, it was just so much fun. And in April of 2005, we got our first quarter results, and we were on target to hit our 25% profit margin for the year. And so I took my management team to the Yale Club to celebrate, and walking back to my apartment that night, I just thought, wow, is that all there is? Like, you know how I'm sure you guys have all had this experience where you work really hard for something and then it's over, right? And there's a letdown and you just feel like, huh. And the next day I was flying to Florida and I just couldn't shake it. And I thought, you know what? If I want my life to have meaning, I really need to do something different. So I got back to my apartment that night. Then I went to the airport again, flew to London and quit my job. And I just thought, okay, I know me. I am not going to be able to not do this, right? If I stay there, I'm going to put everything I have into that because I love working so much. And if I really want to find out, like, how can my life have more meaning, I need to pause. And so I retired at the end of 2005. I gave them plenty of time. And then by 2008, I failed retirement. In those couple of years, I actually traveled around the world getting involved in causes I cared about because I thought, okay, that's how I will have impact in the world. I will be a philanthropist and I'll get involved, with causes on the ground. I quickly found I was not made to be that person. It just wasn't in me to do those kinds of things or have that, that kind of mindset because I wanted to make everything more efficient and, duplicate it. And, that's just how my mind worked. Also, everywhere I went, I couldn't help but see investment opportunity. And so by 2007, I was invited to join a mutual fund board, which I loved. And then in the same year, I was invited to join a think tank discussion group in London. And our topic was, how do we use capitalism to solve social problems? And I thought, well, that's what we should do, right? It just makes so much sense because if we can get all these companies behaving better and doing the right things, then we can really start solving a lot of these problems. And since most of the capital in the world is in people's investment bucket, we need to change how they think about investing. And it made so much sense to me that I thought, as soon as I tell people this, they're going to get it. Everybody is going to get on board with it. And then I found out that wasn't true. People are pretty stuck in how they think, and they didn't really want to think about it differently. And even Max and I were talking on the car on the way here, and I said, it was so disappointing because I got that the Wall Street people weren't going to get it, but I thought, all these people who are saying that they're impact people, they're going to get it. But they didn't. They really saw anybody who came from Wall Street or the financial world as, you're really a sheep in wolf's clothing. And then the problem was my Wall Street friends said, you're a wolf in sheep's, or sheep in wolf's, the backwards, whatever. So I couldn't win. And I just thought, oh man, this is going to be harder than I thought. But in 2008, I decided to start TriLinc because I wanted to prove that you don't have to give up investment return to do good. But you do have to have a good investment thesis. And then you have to be really disciplined about how you not just do your investments, but about how you track and report on your impact and on your ESG screening. And so from the very beginning, we were very deliberate about how we were doing that. And one of the benefits we had starting it from scratch is that we were able to say, okay, if you're going to start it from scratch, what would you do? And one of the things that we did was we put the ESG and impact team as part of our investment team. And so, in fact, 2 of our members are here of our ESG and impact team, and they've always been integrated with the investment team. And I think it made a huge difference going forward. Now, a lot of things have changed in, I don't know how many years that is, but 15 years. But unfortunately, it hasn't like caught up as fast as I thought it would. I literally did think, as soon as everybody hears this, they're going to be so excited and they're going to get it. And yeah, it didn't work that way. But I will say that we've been somewhat successful in raising money. So our first fund, we raised $350 million. That allowed us to launch some institutional funds. So we now have 4 funds, about $500 million. I wanted to be at billions, but we're not there yet, but we're getting there. We did have COVID, which, everybody says, but come on. And I'm like, I know, but that's really no excuse. We need to be better. So we're still growing, and we're really excited to be doing things with UCLA. I was thrilled when they reached out because of Alena. She, as you heard, she used to work with us, and been excited that she's gone on to do bigger and better things of her own. So thank you all for having me.
As Gloria said, I used to work at TriLinc. That's where was my first US investment job. And I had no clue what impact investing is. I was like, what is this? I'm like, oh, but you know what? I'm an immigrant. This is my first job. I will stick it out and I will learn. And it's definitely inspired me. 9 years later, I'm still doing impact. So
I love that.
Thanks for that. So I think first question I want to talk about is how that evolution actually happening. Since you had that idea about philanthropy, then it's like, no, we can make money. We can make money and do good. 15 years ago when you launched TriLinc, where impact investing was then and where it's now? Like what happened? What do you see progressed? What actually you wish were better right now?
Oh, there's a lot of things, but the industry at the time, back in 2007, really wasn't an industry yet. It wasn't even coalesced around anything. There were disparate efforts. So there was SRI, socially responsible investing. There was a form of ESG. There was, in Europe, there was triple bottom line investing, which actually is the genesis of our company name, TriLinc Global, because I thought triple bottom line is what would stick. It didn't. So, but that's okay. So when I have to tell the story, people ask, what's behind your name? I'm like, I wish I had a better story. But anyway, so it was very disparate. And then the Rockefeller Foundation got behind it as trying to build it as an industry. And then JP Morgan got behind it. And one of the things I knew from being in big organizations is that you have to have some level of standardization in order for, everybody to look at it the same way to really get scale. And so we, from the beginning, said, look, we're going to look at all of the field building types of exercises that are happening, and where we think there is going to be momentum, we will get behind that and support it. We're not going to do our own thing. We're going to try to help the field building. Other than from an investment perspective, we're going to do our own thing. But so we were a founding member of the Global Investing Network. We were an early adopter of PRI, of even B Lab. I think we did a lot of those early on just because we really wanted to help support the industry. And from the beginning, we actually have always used the IRIS metrics because you do need a common standard for measuring things, right? And so we thought, there were so many people saying, oh no, but I want to do it this way. I want to do it this way. And we're like, we're not going to be one of those people because we aren't experts in that, right? Let somebody else be the expert in that. We'll do what we do well, and then we'll help again with field building. Sadly, I think there was good momentum in 2009, 2010. And so I really did think, oh wow, this is such good momentum that people will finally start coming together. And it just didn't happen. As you guys probably know, yes, impact investing sort of was the label that got put on it. But in all these years, there's still been disagreements about, are ESG and impact the same thing? And is socially responsible investing the same thing? And they argue about it as an industry all the time. And it's frustrating because you'd think by now it would be settled. And then sadly, in the last couple of years, ESG has gotten so politicized that you almost want to run away from it, right? And again, Max and I were talking in the car on the way here, and I said, I never understand like why anyone would say, I want to invest in companies that harm the environment, that hurt their employees, and don't have good governance. And I'm like, I don't get that. Like, that's what ESG is, right? It's just saying you've got good policies and practices. And so, sadly, I think we have such a long way to go. There's good things happening. There's more, right? Like when you joined, there weren't very many impact investing firms.
No.
And now there's a lot more. So I think from people recognizing that is where we need to go, it's happening.
Yeah.
It's just happening slow.
No, absolutely. And when I joined my previous firm, Aegon, where we would start to build what now became CurvePoint Capital, our strategy we called Impact Venture Debt. And probably a year after, we scraped the name Impact from our name because we were so tired going into the rooms and talking about what we are trying to do. Oh, you're philanthropic capital. We're like,
Yes.
we are not. We're financial returns first, and we're as much caring about the impact. So how do you think that changed over time? Or it didn't change?
It hasn't
You're
changed.
still doing that educational piece for investors.
Yes, and it's funny because, so our first fund is a public fund. It's still there. And so we were selling to broker dealers who are financial advisors who then would sell it to their clients. And there's a way, we hired a third-party distributor, and there's a way you sell into that group. And so they would hold these conferences at a really nice hotel, right? And then we would come in and we would give our presentation. And the first meeting that we had, we're in a room about this size. Actually, we've got maybe 100 of these financial advisors, and we're so excited. And the order of our presentation was, I would get up and talk about impact investing. And this is why it's so important that you know this as a financial advisor. And then Paul Sanford, our CIO, would get up and talk about the investment strategy. And I'm standing up there talking, and literally you could see all these advisors looking like, what is she talking about? Like, to the point where they weren't even paying attention. So by the time Paul got up there, they really weren't paying attention. They had no idea what we were talking about just because they were so lost by my introduction. And so that night, we had another one the next day. And so that night I said, Paul, let's try to switch this. Like, why don't you go first? You talk about the investment strategy, and then I'll say, and oh, by the way, there's this really cool bonus. And as soon as we did that, everybody was like, wow, that's the coolest thing ever. And we thought, well, all we had to do was switch it so people could connect first, and then with something they understood, right? And then introduce something that they don't understand. And I think there's still a lot of that education happening because everybody assumes it's, you're going to give up on return.
Yeah, which is not the case. I'm a true believer that impact actually drives the alpha, because if you're running, to your point, ESG is just run the company in a good way, and then impact, if you're creating an impact, it will get you more customers, you better margins, you will get to more markets. It just makes total sense.
It does.
Why people don't understand this. But to your point, the first fund was a flagship fund, and it was a retail fund.
Yes.
You were selling to individuals, not non-accredited investors, if I'm using correct definition. Yeah. So it was, what was the minimum investment amount?
2,500.
2,500.
Yeah.
So we're talking a lot about impact on the investment piece, right? To close the financial gap and provide more flexible solutions. But we never talked much about the impact that you were trying to do for people in the US to invest in and kind of lower that border to access this type of investment. How did you come up with that idea, and why?
That's a really great question. So part of it was self-serving. So when you are starting an asset management firm, and I'd spent my whole career in Wall Street, so I knew this, right? You can't get scale by starting with institutional investors. Everybody wants to do that, but you can't. They need a track record. They need, a certain amount of people doing the same thing for a certain amount of time with assets under management. So I was like, okay, can't go institutional. We could go high net worth first, but getting to them at scale is really hard. And we have a message that is new, right? Impact investing. And so basically, if we want to sell a new fund with no track record, with a new message, and so the independent broker deal, and I had managed a broker dealer as in part of my career, so I knew how they were motivated. And I thought, well, okay, if we have a good message, if we do all this education, we will be able to raise capital. And once we do, then we'll have the track record to go institutional and raise additional capital. So that was the self-serving part of it. But I also was excited about it because I thought, well, up to that point, any kind of impact product was only available to really wealthy people. And so I thought, well, look, this way, we educate all of these advisors and all of these investors, and we can help the industry grow faster because we're educating so many people. And we actually did, oh my gosh, I forget how many thousands of meetings, but we gave presentations to over 400,000 investors and like 3,000 financial advisors. We were on the road in places of the US you didn't even know existed. But we ended up, we have 8,000 investors in that fund, and from all 50 states, and our average investment size ticket was about $36,000. So it was true mom and pop. So we felt like, well, we did accomplish that goal of educating a lot of people about something that people should know about, which that part we're very excited. But like I said, we wanted to raise more money than we did, so.
It's always like that. But obviously, you're not taking easy routes. And another non-easy route you decided to take is to create a private credit fund.
Yeah.
It wasn't an equity, it wasn't venture, it was private credit. It still is, maybe with a sprinkle of equity here and there. And I run a private credit fund, and I know that majority of the time when you talk to founders or CEOs, they're very proud. I don't have debt on my balance sheet. I'm like, you're kind of stupid.
Yeah, exactly.
You're not leveraging right resources to build your company. But credit has a lot of negative connotation to that, because when things go wrong, everyone thinks that we have nothing better to do to come and take over your company.
Right.
It's absolutely not the case. So why credit? And then you layered emerging markets on top of that. So it's completely gets super complicated. But I really want to talk more around, why do you believe that credit is impactful, and what exactly that asset class does for the companies, for the founders, and obviously their impact on the communities thereof?
Yes, it's a great question. And I'm going to give my disclaimer first. I do like private equity. Every time I make this statement, people think I don't like private equity, but I do. However, when it comes to impact, particularly in emerging markets, basically, when we as Westerners, as US investors, right, go into a market and we are investing in a company, if we are putting in equity, and there is some successful exit, which exits are hard in these markets to begin with, but let's say there is some successful exit, well, then we take our money and bring it back here, right? So it doesn't stay there in the market. Whereas if we're lending to a company and we are earning money for our investors at the rate we're supposed to, when that company is successful, all of that money stays there. And it gets reinvested in the community because it makes the owners wealthy, it makes the employees wealthy. And so I really do believe that in a lot of circumstances, credit is more impactful than equity. Now, it's not always appropriate, and it's not sexy. So a lot of investors didn't like it, right? They're starting to now, but especially back then, everybody was like, private credit, why are you doing that? Now, the other reason we went with credit is if you think about who we were selling to, we're selling to mom and pop, middle American, and they're concerned about income because they're going to be retiring. They can't afford to lose money. And so they just need a steady state of income. So credit is perfect for that, right? And private credit is safer than public securities for sure. And the last 10 years has really proven that. And so for who we were selling to, it really made a lot of sense. From an impact perspective, it made a lot of sense. And then what was not expected was through COVID, we were able to prove that being a lender was a lot better because we had a lot more control. Because every other company, we were able to get with them and assess, okay, can they make it through this, right? What's the likelihood that they'll get through it if we just restructure and we work with them? And so now a lot of our companies are finally coming out of it and starting to improve, and they're starting to be able to repay their loans. Now, it took a while, but if we didn't have the assets we have, like as collateral, if we hadn't structured it the right way, we would have had a lot more losses than we did. And now we created a lot more impact too. We did 60-second borrower video. Is that what it was? 60-second borrower videos from some of our companies, which you can see on our website, from these borrowers, because they're mostly entrepreneurs, right? And some of these companies have been in their families for generations. And they did a video for us telling a little bit about their company, but basically thanking our investors for sticking it out and committing to repay the loan. Because it's so important to small business owners. So I think it's tremendously impactful.
Yeah, no, I agree.
You know that too.
I agree, absolutely. I love to get into the debate about private debt, but you talked about the restructuring piece. When you are looking at these situations, what hat is first? Is your impact hat? You're like, how can I save them? Or it's, yeah.
No, we're financial first impact investors. Yeah. However, in that case, we're working with the founders and to keep them as CEO under a management contract and allow them to buy it back. But we have to be able to manage it to a financial result that makes sense for our investors. And if they're in the way of that, well, then we need to get them out of the way. And so, again, with credit, you have a lot more control over those kinds of things. So we are absolutely a financial first impact investor, but we're definitely more patient than large institutional private credit investors, right? Like a bank, for example, they would have written these positions off a long time ago for 10, 20 cents on the dollar because it just wasn't worth it to them. And, I think that's also not good for investors. But if you're big enough, I guess you can do that.
Yeah, absolutely. So when we go through the investment process and we look at ESG and impact assessments, and you kind of talk with founders and CEOs of the firms about metrics, right? What KPI metrics you guys agree to report? Most of the time, I would presume it comes from the data they already have, and how do we manage to correlate it to IRIS metrics. But it's additional reporting layer for them because they need to run the company, they need to give you monthly financials, quarterly, annual, collateral reports. It's a long list. And then you slap impact metrics on top of that. Have you had pushback on the reporting for impact?
I don't know, Max, do we have pushback? Everybody does it. And I think that's the key, and we were hoping this would happen, but we did find that it worked, is if they want the money, then they've got to do this because otherwise they don't get the money. And the other thing is, and we've really streamlined it over the years, but from the beginning we said we need to make it as meaningful as possible, but as easy as possible for the borrower companies. So a lot of our metrics, our impact metrics that we were measuring at the portfolio level come from their financials so that they didn't have to do extra reporting. But we also want our borrower companies to be somehow engaged in impact, like intentional impact. So they got to pick impact objectives that aligned with their business or with outside activities that they do. We used to let them pick as many as they wanted. And then we realized that's not a good idea. We should actually help them pick the metrics and then maybe pick one, maybe two. And so, like I said, we've streamlined it a lot. We've gotten better. But from the beginning, we tried to learn from other people. So we went and sat with the IFC, which is the investing arm of the World Bank, because that's what they do, right? They invest in small businesses all over the world for impact. And so they had a well-developed system already. So we went and they shared it with us and we were like, all right, we'll adopt that. And then we worked with another development bank 2-3 years ago, and they have even improved on that. And so we adopted some of those things. So we're just getting better at it.
Awesome. So what excites you about the future of impact investing? Where you feel is the biggest place for growth?
Oh, that's a great question. I do think that there's going to be, in the next 10 years at least, there's going to be a lot of opportunity in climate, which is good that you're doing what you're doing, because everybody is now realizing it's real, right? You can't hide from it. It's just, no matter what, you see it, right, everywhere. And so I really do think we're going to see a lot of growth and focus on climate. I also think just because of population, we're going to eventually see people focus more on developing economies, sort of the higher end of emerging markets. We had a slide in our presentation when we were doing our roadshows to help people understand why we were focused on developing economies. And the statistics, I think, are even more glaring now, but I was born in 1960, so yeah, you can all figure out how old I am. And back then, there were less than 3 billion people in the world. Anybody know how many there are today?
7.
9 billion. We're going to 9. We're 7.5 or something right now, quickly getting to 9. And if you think about that, you go, wow, that's huge population growth. But guess what? Only about 1 billion people in 1960 were in advanced economies like the US. Today, only about 1 billion people are in advanced economies like the US. So all of that growth has happened in emerging markets. And you go, well, eventually that is going to make a difference, right? For the countries that have strong rule of law, who are doing the right things to try to become an advanced economy, their population is just going to drive that. And so I do think we'll see more happening in emerging markets. I don't know if the Americans will ever get around it, but we're very parochial. And more than I grew up in Ohio, and you would have thought I would have remembered that. But when we went to sell our fund, boy, that was our biggest objection, was emerging markets. And you could tell the great story, you tell them, how you're securing everything. It just.
But then you need to educate that Africa is not a country, right?
Yeah, exactly. I will tell you guys a funny story just because it's so unbelievable. But I was doing another one of these roadshow meetings in St. Louis to a bunch of advisors. And by then we had investments. And so I'm now giving them examples. Like we have this investor. And we had this investor in South Africa that was a retailer. Basically, they imported things like belts and underwear and things like that and accessories. And so I'm telling this story. And during Q&A, the first question, this guy stands up and says, wait a minute, you said that you have a company in South Africa that imports things like belts and underwear and what? Do they even wear underwear in Africa?
In South Africa, by the way.
I mean, South Africa. No.
Developed economy.
I know, but I'm like, you seriously just asked me that? Like, of course they do. They wear clothes. Yeah. But that just tells you, some people's in Middle America, their mentality, because they haven't been exposed, right? I think it's getting a little better because of the internet, because everything's becoming more global. But we as America, we are so insulated, right? We don't have to, we have one currency. We don't have to speak more than one language. Until maybe it was right before I left Deutsche Bank. So till 2004 or something, you didn't have to have a passport. to leave to go to Mexico or Canada, so nobody had them. 67% of Americans then didn't have a passport. And so you just think, wow, we are so insulated, right? So as Alena said, we took the hard road by saying emerging markets.
Private credit, emerging markets, impact investing.
Yeah.
You pick your challenge. So I do want to take an opportunity to talk not about investments and impact investing, but more around kind of your career as a female in male-dominated industry. And you spent 30 years on Wall Street with all the white dudes.
All the white dudes, yeah.
So what were some of the biggest challenges for you that you faced in various roles, in juniors and probably seniors even more? How did you overcome them? And what would be your advice for upcoming generation of female leaders?
Yeah, so I'm always not the best person to answer this because I always tell everybody, and I really truly believe this is true, I don't think I was ever discriminated against. I could have been, and I just didn't notice. But I really don't think I was. So I was always the only woman on any management team I was ever on, usually the youngest. And this was at Security Pacific Bank. We had a management team, and it was all these old white men. They're probably the age I am now, but I thought of them as old. And basically, we would be having a management meeting, and there would be some hot topic. And if it got intense, then one of them would say, oh, let's take a break. And then they would all get up, go to the men's room, finish the conversation, and then come back, and it would be resolved. And, for the most part, I really didn't care until it involved me. And this one time I'm in this heated debate with this guy, and somebody says, let's take a break. And I just thought, dang it, they're not going to do that to me. So I just walked into the men's room with them and just kept talking. Now, when I got in there, I'm thinking, now what am I going to do? So I went into the stall and just stood in there and just talk. And then I kept checking, are they gone? Because I was like, I don't want to walk out. But the good thing was they never did it again. And when later somebody was like, well, they did that to you because you were a woman, I was like, I honestly don't think so. I don't think it was even intentional. I think it just happened to be that I couldn't go to the men's room, right? If I was a man, I would have been in there with them and they would have done the same thing. So I don't honestly think that it was, because I was a woman. And then the only other thing that happened to me, and it was not discrimination, it was, so I told you I, was on the bank's executive committee. So every 6 weeks we'd be somewhere in the world. And one of the divisions would get up and make a presentation. And there were 200 managers from all over the world at these. And this one guy was up giving his presentation, and he brought his head of strategy that worked for him, and it was a woman. And the whole time that she's talking, I can see her staring at me. And it was so much so that it was really uncomfortable. And, I'm sitting there going, I can't look away, I can't, And after they're done, I can see her come and make a beeline for me. And I'm just like, oh my gosh, what? And I don't know her, right? And she comes over to me, she grabs my arm and she says, I just have to ask you, what is it like to be the only woman ever in this room? And I looked at her and I looked around and I was like, I honestly never noticed. And I really didn't. My whole career, I did my job. I did what I needed to do. I loved what I did. I worked really hard. I had 3 things that I always told people. I worked really hard, I solved problems, and I helped people. And when I did that, I just did what I needed to do. And if there were things going on that, people were discriminating or whatever, I'm like, I missed it. So I don't know what to tell people. And I know that real discrimination happens, so I don't want to, make light of that. It just never happened to me.
Yeah.
Fortunately. I was lucky.
You were on a mission.
Yeah, I was definitely on a mission.
Thank you so much. I think I'm exhausted my question. I think we talked a lot about, so I guess we can open up for Q&A.
Hey, thanks for doing this. I've learned so much in just a short amount of time. Really appreciate it. My name is Julian. I also work at a large asset manager.
Awesome.
My question to you is, how do you both deal with these ESG type conversations in the US over the past year or two? They're absolutely brutal for me. They're a little easier internationally.
They are.
Yeah, just hoping to see, kind of how you walk into a meeting, knowing maybe based on prior experience with that client, or just honestly based on their location and statistics on like how to be best prepared to handle these types of spicy conversations.
So we talked about that, like how are we going to deal with this? And we ended up, for the US, we basically removed the words ESG from, or letters, whatever, from all of our material. And we call it, we're sustainable investors. And so we sort of changed our language, even though we do the exact same thing. And how we talk about it is that we invest in sustainable, responsible companies. That doesn't seem to raise any issues. You get out of the political fray. And like you said, in Europe, so we have two sets of material because in Europe, they like ESG. And so, we just have to change our language based on where we are. It's just very pragmatic. Like, okay, if you don't like that word, fine, we'll use a different one. We'll do the same thing, but.
Yeah, we do the same with, as I said earlier, we changed the whole strategy name from Impact Venture Debt to then Aegon Climate Capital. So we eliminated that headline for us. And now we lead with the conversation because I invest in climate. So I don't want to get in climate change is real, not real. What we lead with is we're investing in businesses that is a good business decision. And thanks God, climate now is a really good business decision because cost curve went down. So, and Texas, for example, is the largest investor in renewable energy. So they understand that. Now it's not a conversation about impact or climate real. We're like, okay, we're taking good businesses and we're helping them to scale to growth. So catering conversation to the group, absolutely. It's annoying, but you should do that. And yeah, education. And if you're good investment strategy, they will get it.
In fact, when we launched our first institutional fund, so our first fund was TriLinc Global Impact Fund, but we did it because the initials are TGIF, and we were selling to broker dealers. And so that was the name that we used all the time, right? But when we were launching the institutional fund, one of our family offices was being a seed investor in that fund. And they said, look, you got to dump the impact name. So it's the TriLinc Sustainable Income Fund. And then nobody has any objection. It's weird. Language is just, triggering for people.
Yeah.
I'm in the life science area. What about artificial intelligence, in the next 10 years? And that's, for example, it's not going to affect just life sciences, but all industries. So let's say AI can improve the speed of getting to, let's say, therapies for cancer therapeutics, then you'll have a huge population living a lot longer and in a healthy condition. So you have to have a planet that's sustainable enough to support a population, a much larger population that's living longer and living healthier. So does that come into your calculations, AI, for example?
Yes, for exactly the reason you just said. So remember before when I said one of the trends is there's this population growth, and feeding into that is they are going to live longer. They're already living longer, right? And we are going to have to figure out how do we make this planet last for all of those people. And that is why, I always thought, well, it just makes so much sense. If we need to get companies on board with this, we need to get everybody changing and thinking okay, how can I take care of this planet? And it's hard because, people have their own agenda, people have their own views and not the bigger picture. From our perspective, it's, again, one of the reasons that we started in emerging markets is because we think there's tremendous opportunity there, and will continue to be as the world grows and changes and improves. And you probably know this, but technology is way more advanced in many of these countries than here because they get to leapfrog right over all of the embedded history that we have, like our old technology, right? A brand new company starting up has a huge advantage coming into these days, right? Because you have no baggage, like you have nothing you have to overcome. And that's what we see a lot in emerging markets. And so I think AI is going to play a huge role. I love it personally. I wish we could use it more, better. We use it like whenever we can, but we don't have somebody who like knows how to program with it or anything. And I'm not sure what exactly we would use it for in that regard. But I think it's a really important point.
Yeah, my name is Brandon Cawley. I got a 2-part question. When it comes to like investments and stuff like that, do you ever like look towards small business startups that do green energy and investing in them? And the second part is like when it comes to spatial computing and technology in general, what role do you see that playing like in order for us to like not only elevate that but even getting the people who are non-technical or don't even understand it involved, like because they're not like majority of people don't even understand, like we use AI, we've been using AI since 54.
Wow, cool.
But so how do you get the normal everyday person to even be a part of that progression without forcing it upon them?
I'm going to answer the second part first, but because I think that's hard, and I think you will continue for decades probably. You'll continue to run into challenges because the people who are, I'm going to say, maybe 50 years and older, who maybe 45 even, who control a lot of the money still. They're probably not going to change. It's going to be hard to educate them. Some of them get it. Some of them are embracing it. Some of them are going to go, wow, that's cool. But a lot of people are just afraid of it, or they don't want to learn. They don't want to deal with it, right? If they're younger, I don't think you'll have any trouble. The only problem is they don't have any money yet. So, but there will come a time when that will change, right? The money is going to get passed down. The younger people that are now younger will become older and have their own money. And I do believe that will change over time. So that one's going to be tough, like educating the people. So you just have to be careful, who your audience is and what's possible. For this first question, we don't do any early stage investing. We only do private credit for growth stage companies where they have revenue, they're profitable, and it's just because of who our investors are and what they want from us. Like that's what they're buying is this predictable income with a stable, company. She knows a lot more about that than I do because she's been a lot more involved in all things equity and venture, and so.
Yeah. No, we do invest in earlier stage than you guys, not at venture stage, not like pre-seed, seed. We come in Series C and beyond where they have revenues, they have customers. We're not taking tech risk. And the reason we're doing that because I'm a finance person. Like I'm not, besides money, I'm not bringing any value to the early stage companies. I cannot sit on the board and tell them, you need to tweak your chemistry, you need to change your engineering. This doesn't make sense because I don't know. And I'm a true believer that you as an investor should bring not just cash, you need to bring years of expertise, you need to bring your connections, you need to open doors for these people so they can get to this later stage when I'm investing, Gloria is investing. But we're finance people, our expertise in finance and capital structures and capital stack matters when they already have done all of that. The tech risk is not there anymore. They just need to scale. And that's where education on private credit, education on different alternative financing structures, education on how to bring into like mid-market, like true private equity people, what they need to get there. That's where we come in and we play more valuable role than just writing checks.
Yeah, and it's interesting. I'm glad you said that because if you think about investing, 90% of investing involves a company, and all companies start somewhere, right? And usually that's the early stage, and it's usually friends and family, or it is angel networks, or it is, like you said, tech investors, like who have an expertise in something and want to support others who have that expertise. That is a group of people who do that, or a group of investors who do that. Once a company advances, then they're going to go early stage venture, or eventually they'll move up to private equity. And there are people who specialize in those, like investors who specialize in that and only invest in that. And then as you move up and your company gets more revenue, gets more successful, then you can finally start attracting debt, which is what you want to do. Like your point earlier, like if you don't have debt on your company, then you're really not smart about it. You should be leveraging the resources that are there. But you're not going to get it unless you're already generating revenue. I even remember talking to the bank when I first started TriLinc, and we had no revenue, but it was like, wow, we have investors, we have this good business plan, we can see our way to revenue. The bank was like, nope, until you have this much revenue and profit, we won't lend you money. And I said, but by then I don't need your money. Like, I don't get that. But that is how they view the world, right? And it's just based on where you are in your development as a company, who you will target for investment. And you just need to get to know at each segment who is that, right? And get into those networks.
My name is Navin, and I just want to thank you for such a great conversation. There's quite a few of us here from the Impact Investing Club on campus, and I've met a bunch of other clubs across MBA programs across the globe, so I can tell you that impact investing has gained a lot of interest from young people. And then my question is actually on your focus on the emerging markets. I'm from Cambodia myself. I know that a lot of business owners across these emerging markets aren't necessarily super sophisticated. I still can't explain to my mom what I'm doing. I did investment banking. She has no idea what it means to sell a company. But yeah, just want to ask you, when you go out and source these companies, how do you go about educating them on the investing principles or the tools that you have that you can support them? And then my second question is that once they're in your portfolio, how do you go about providing the best support for these business owners who are operating in a country that's very different from the US?
Yeah, great questions. On the first one, it was a nice surprise when we started investing in emerging markets, when we would meet with business owners, and we found out that a lot of them already had some kind of, they usually called it E&S, they would leave out the G, like it was environmental sustainability reporting, because most of the money in those markets historically had come from development finance institutions like the IFC or DEG, all these development banks. Development banks require that kind of reporting to get money from them. And so we were pleasantly surprised that they were already familiar with this kind of tracking and reporting. And so it wasn't a big leap for them to be able to do what we needed them to do. And I don't know, we get very little resistance on any of those things. The other thing is we have now 12, 13 years of experience investing. And so we have a lot more resources that we can offer to companies because we've worked with so many different companies in a lot of these different countries. And we know where there are standards that are going to be similar, where we can offer help, or we can connect them with technical assistance that is specific to what they need. In some cases, depending on it usually is around environmental, but it might be social. We would require them to hire a specialist to come in and develop a plan, an environmental social plan to make improvements. And again, if they want the money, they have to do it and they have to show progress against that. But I would say most of them realize that it will make them a better company. And so we don't get much resistance. And then how we find those companies is we have agents, partners, whatever you want to call it, lawyers, people all over the world who we've worked with, who we know, who basically source loans for us. And they know the people on the ground in those markets. Now, we also do have consultants who are dedicated to us in some of the markets, who work with the borrowers on the ground. But if we've got a company that's got particular challenges, one of the first screens that we do before even our first credit committee is Max and his team will do basically an ESG screen. And if there are lots of red flags, they'll meet with the company, talk to them and see, are you committed to making this much progress in this short of time frame? And if they won't or can't, then we don't even do credit analysis, right? Because we're just not going to take that kind of risk. If they say, no, we know there's those kind of risks, but we're willing to help, improvement, then we actually then we take it to the credit committee. And if it's a good deal, credit deal, then we'll do it. Now, if it's not a good credit deal, no matter how much impact there is, we won't do it. And it's vice versa, right? It could be really great on financials, but there's no impact and there's no opportunity, then we won't do that either. So
hopefully we can connect and have more of these conversations continue after.
Okay.
My name is Dave, and I grew up in Silicon Valley, but I realized when I was growing up and then working there just after university that Silicon Valley had become what I think is the global epicenter for inequality. How entrepreneurship and investment is often perceived there as designed to exploit inequality and then designed to exacerbate inequality. How do we work to change values so that we actually can leverage these incredible tools of entrepreneurship and innovation and tech and venture capital, et cetera, to solve problems, to build towards a better world rather than this current trajectory that we're still on?
Great question. It's going to take a lot of hard work. And just like when I decided to start TriLinc, I can see the big picture, and I just like you, right? You can see, oh my gosh, there's so much to do, and we really need to change all these things. But you go, well, you're only one person, or you're 20 people, whatever your company is, and so you have to sort of pick a lane and say, okay, this is what I'm going to focus on changing, and I'm going to support the ecosystem the best I can, so that everybody else can do their part, right? And hopefully we can all change it together, but it is going to be hard work, right? Because we've got, the whole history of the universe that has seen the world or seen problems a certain way, seen opportunity a certain way. And it's hard. I mean, it's going to be hard. And you have to, say, okay, here's how I can make a difference. Here's what I can do, and just keep doing it.
Yeah, and as Gloria went into the men's room, people like us need to go to the rooms that we are not welcome. And I'm glad to see it's a very diverse crowd here as well. So it means that people that attend Anderson are here to change things, and it will take each one of us to do small changes, and then we group together, and it's a bigger change, but it's everyday work. Doing these talks, education, and then asking hard questions and asking okay, we identified the challenge, we identified the problems. Give me top 3 solutions. What do you think will be different? And doing stuff, investing in specific companies and being very focused, not just on financial returns, which I'm all for, but stick with your impact and ESG assessments. If it doesn't fit, it doesn't fit. Don't try to wiggle the way because it will work in financial returns better. It's stick to your principles and just keep getting there, and then we will run the billion-dollar companies and invest in correct ones. So yeah.
Well, thank you both so much for a wonderful discussion and for answering all those questions. And please join me in welcoming them and thanking them one more time.